In this video, I'm going to talk about the order blocks, the strategy that I use to trade with the market on Forex. What is the order blocks, how they work, how to identify, and everything you need before to take a good entry inside the market Forex, in the Forex market. So let's rock with this video. What are order blocks? If you are familiar with trading, you may have heard of order blocks, which are very special bid and ask zones. Banks use orders when buying and selling their profits. However, institutions do not use all of their capital at one level, but rather use their orders in several blocks to manage them easily. When the market rises, institutions sell, and when the market falls, they buy. Therefore, order blocks are zones endowed with a set of buy or sell orders by powerful institutions that push the price in the direction they want with great force. An order block is a specific candlestick and is very easy to identify on the chart. The order block will be identified with the last opposing candle before the big impulse. But this will give us many order blocks, but it does not mean that we should enter all of them. We should look for order blocks that are favorable to the trend. The ones that look for retracement and contain liquidity. This way we will know that the market will go for that liquidity and then continue with its trend. It is not an exact science, but believe me, it is an easy and effective way to trade Forex. In this graphic, we have an example of how order blocks are handled. This is a signal sent in my signals group. I was waiting for a pullback in the price and then continue with the downtrend of the US 30. Now, for this entry, I waited for the liquidity in the market to fill. We see our huge order block and look for our reaction zone. To find your reaction zone, you must look at the chart in different time frames to find a favorable zone for your entry. I always set a stop loss above the last high or below the last low so that the chart doesn't take me out too fast by not leaving a few more pips. Sometimes the price does not touch the order block candle, and what it does is retrace through the Fibonacci levels. In this sense, the most important area to trade is between 61.8 and 79 or 80, an area that some experts call optimal trade entry. If the price breaches the order block, the resulting reaction zone could function as resistance or support. In this case, the order block is not respected because of two circumstances. The order block is higher than the one displayed, or you are trading with a trap pattern. I compensate this with the leverage of each trade, and something you should know is that it is no good to have entries with 3 or 5 or 10 pips of stop loss if you have a very large loss radius. If you manage a radius of 10 to 1, sooner or later this type of strategy will not work, since you need a little bit of luck for that winning trade to leave the other 10 losses in profits. I mean, you must manage your entries better and manage your risk and profit very well to avoid stress, that stress that is generated by many losing trades. As you can see, the strategy is simple at first sight, but you must practice your eye. Do back testing looking for order blocks, watch the news, see how the news influences those strong movements, and look at the fear and greed index to get an idea of how the market and its traders are doing. You will improve all this by using indicators and practicing every day. Join my signals group, free and VIP, to receive more information and signals like this one. See you in the next wave.